Okay, Peter. MCM_CT?
Yep, that would be it.
All right, buddy. All right, so I'm going to give you the screen too, so we could see your setup. I think you were made just a panelist. Yeah, I'm going to make you the presenter. And then you could share your setup, and it's great to have you back, Peter. This is a return interview for Peter, and I've been following his work on Twitter. Last time, Peter, you talked about the similarities of music and the market. You know, that's probably where harmonics come from. So what's on your radar here lately? I've been following you.
This is a very interesting time. I don't know. Let's see. How do I? Okay, there should be able.
Okay, we're looking at. I'm not sure what the chart is, but you have a few lines. It looks like you have a fractal for the S&Ps here.
Well, what I'm going to go over is a few different things. One is United States dollar, which we've been talking about for a long time. And so these are cycles, and I think it's important to come back and talk about the dollar because I have a very different view of the dollar than what people might believe might be the case at this moment. Basically, okay. I believe that the yen is going to strengthen, which ordinarily would mean that the dollar would weaken. But what I believe is most likely to happen is the opposite of what people think will happen to the dollar. I think that the yen will strengthen and the dollar will strengthen. And that's despite what people might be thinking about what the central banks might be doing. And I want to talk about a little bit why
is that kind of like a risk-off scenario for you, Peter, where
it's not
dollar
really a
strength?
Risk-off scenario, it's a double risk-off scenario because in the equity markets and risk markets, you need to have more or less a carry trade in progress. And if the yen is basically going to strengthen, we're going to end up unwinding carry trades. And if the dollar strengthens, that's going to make a very sick environment for the carry trades to be unwound into. Sorry. I can't believe I said unwinded. But anyway.
We'll edit it out. We'll edit it, buddy.
Perfect. Basically, from where we are in the dollar cycle fractals that I look at, we are in the danger of breaking out of significant impulses higher. And I discussed this last time. These are cycles. So wherever I get this magenta line, for example, that is a resistance cycle. And I talk about these things on Twitter quite often.
Yes.
And these are like sort of the way I would refer to them is you have energy, and energy, you can think of it as an ocean. And in the ocean, you have oscillating waves that basically do not transport fluid or material. They just oscillate, and you basically are moving up and down and sideways, not really going anywhere. And then you have currents and larger waves. And how those currents and larger waves sort of end up happening is many times, most of the time, out of collisions of oscillating waves that collide in a way that create force. And so when I get a resistance cycle here, this is basically cycling energy. It's an oscillation energy. It's sideways, more or less, energy consolidation.
Yeah, those are the waves doing nothing, right, Peter? Yes. Kind of like a cork bobbing up and down in the ocean, going nowhere.
Exactly.
Okay.
And, you can go somewhere. Like you can see here, we have oscillating waves that are going into a high for the dollar over here, and they're oscillating. They're not impulsive. Now, what creates an impulsing wave is when you collide with enough energy and break the oscillation. So that means that you have several oscillations or several causes potentially that come together and release energy sufficient to break the oscillation, which then creates a transport mechanism. And so impulsive waves, kind of like Elliott wave, create direction and travel. So price travels. So what we have here on a quarterly chart is, I believe this is a quarterly chart. Let me just see.
So this is for directionality. It doesn't provide amplitude for you for targets. It's giving you the direction, correct?
It's giving me context, time, and general sort of direction. Yeah. Okay. So the biggest thing that I like to use in trading is time. I like to understand that the time and the use of time is very independent of price, and so time can move very. You can extend in price, but correspond to a very truncated price, a time window. So time for me is actually more important than price a lot of times, because I can't predict where a price will end. And in the example is in this ramp that we have off the lows, there's so much intervention and other kinds of forces going on. Time actually represents a better mechanism than price in a lot of senses to understand when you've exhausted the energy transmission and release. And that's what this is about. So I just want to finish this. On the quarterly chart, we have an impulse where we broke out over here, if you guys can see that. And then we have this bullish retracement. Now, in currencies, what happens is that a bullish retracement like this can send the market like way, way up. And this is a quarterly chart. So, the usual scenario is that we're going to get another 3 or 4 quarters of strength on the dollar. Now, these are energy-based charts, so it's very different from looking at a fundamental analysis. And then what we see on the monthly chart is that we have had very good oscillating energy, and there's been no impulses here. It's just been oscillations. So when you get oscillations for this length of time, if we break out over this resistance cycle, we're going to get a monthly impulse. And the monthly impulse is going to send this thing flying. Now, what we have over here on a weekly chart is a monthly impulse, a weekly impulse. And what you see is we broke out of the weekly impulse, and I've been posting that we need to remain above basically 93.85 for the bullish case. I would say 93.60 on the DXY index for the bullish case. We could overshoot a little bit, kind of like what happened here. But that has been the case. We have been remaining in a positive impulse structure on 2 very long time frames, and at the risk of breaking out of an impulse over 97.03. So if we break 97.03, which I think has a very high odds of happening because we're in nested impulses, then we're probably looking at 106 to 109 on the dollar in pretty short order. And that says something about the world and about credit and about other stuff. And so, how I see this is that the dollar
deflationary, right, buddy?
What?
Deflationary.
Yeah, deflationary. So what I think we're seeing is a deflationary cycle where every time we get a little deflation, basically the powers that be panic, and that's exactly what the Fed did. But the Fed has created a situation in which the results of their handiwork are global, and the ECB took the baton, and Bank of China and Bank of Japan, and you just reach a point where people created too much credit and too much deception and too much stuff, and they can't get it back in the box. And I think that's where we are. So the go-to instrument, the dollar.
Yeah, I'd like to pose this to you just quickly before you go into the dollar. Technically, is that what the Fed and other central banks do, have a lag time before they hit the economy? So even if the Fed is on pause, on hold now, we haven't seen the effects of what they've already done?
Yeah, and that's a really important point, is that depending on how they act, the lag time, certain things could be 6 months, but most of the time it's 9 months to 12 months.
Okay,
And
I didn't know that. Thank you.
the lag times are very long.
Okay.
And the policies that the Fed has are very imprecise. And the problem is we have a bunch of central banks who can no longer cooperate. And then we have a situation, well, they can cooperate, but they cannot cooperate well. And then you have a tremendous amount of dollar denominated credit that is not in the U.S. And so
Emerging markets you're talking about, they have dollar denominated debt.
Yeah, in Europe, in China, China has been, in their thirst for leverage, they've been creating more dollar denominated loans in China than they have for a very, very long time recently.
Interesting.
So it's not something that people are aware of.
I didn't know that. Yeah, I didn't know that they did. How do they do that? What kind of instruments are they? They just bank loans based in dollars instead of won?
They create bank loans denominated in dollars. And people apparently buy them or want them because they buy into this idea that the dollar will go down and they can buy the loans back cheaper. But I really don't understand why somebody would go on a suicide mission like that, because it just doesn't seem very logical to me. Every time the emerging markets gets sold on the idea that you can denominate debt in dollars, when it's widely adopted, the next thing they have is a crisis. So I think the dollar is the key. And I want to just show you right over here. Here is an example of an impulse. So we are in an impulse here, and it's a long sideways consolidation at this point. And this is not unusual. But if we hold this support, we can easily get a move like this in the dollar. And we're already on a quarterly chart in something that it will need some effort to get it unwound. So this energy, so here's an example of this upward impulse. So we get an upward impulse, or we get this upward impulse, and we need 2 ends or 3 ends to dissipate the energy. And what that means is that you have at least 3 oscillations after a big impulse that are required to sort of transition the energy from directional energy to consolidation energy, which then can either create a new impulse upwards or reverse downwards. And
interesting, the number 3, Peter, because I teach and look for a lot of 3 drive formations. So from your methodology, it kind of verifies that 3, and you're right, there's sometimes 3 drives to a top or bottom. The formation fails because it ends up being a continuation move instead of reversal, but kind of confirms to me that 3 is a very important number.
It is, especially when you go to longer time frames, like here on this monthly chart. You can see we get a third end down. So we had a large sell-off in the dollar for an extended period into 2000, basically 9 or 8 or whatever. And it took until we got the third end to put a base in. And then all of a sudden we started getting moves that were upward direction. But we still haven't had a monthly impulse up. I'm expecting we're going to get a monthly impulse up. And everybody in the world right now is looking for a weakening dollar because they think that the Fed is going to loosen the policy. And the problem is really, I think, bigger than what the Fed can handle. So that's why I wanted to start with the dollar, because I think that the key to the dollar right now is 93.85-ish, 93.60. If we can remain over that, I think that we breaking out over basically 97.03 could trigger a gigantic move in the dollar. And I think that when you look at where we are, basically around 96, this is not a lot of room. The dollar is at a point where a decision can be made. And for a lot of the people expecting very big declines in the dollar, it's not cooperating. It is not cooperating.
Yeah, didn't last week kind of show it? They gave the dollar bears on Fed Day and the press conference everything they wanted to hear. The dollar got hammered with no follow through the next couple of days.
Exactly. And then look at the dollar versus the CNY. I mean, there's something wrong. Look at the dollar against the Japanese yen. And when I can see the dollar holding up like it is and the Japanese yen as strong as it is, well, we are heading for, I think, an epic crisis. This is not a small deal. Now, I have been...
Let me just clarify for our viewers. When you talk about yen strength, are you talking about U.S. dollar Japanese yen going up or yen strength with USD Japanese yen going down?
What I'm talking about is the Japanese currency strengthening against the U.S. currency.
Okay, well, that means USD JPY will be heading south.
Yes, and that means in general that we would be looking for the dollar to weaken globally in that scenario. So you would see the dollar dropping in a pretty big move if the rest of the world's currencies agreed with the yen. But what I don't see is that happening. Firstly, the dollar remains extremely strong relative to what's been going on with the yen, in the dollar index.
Right.
Now, and then I think that the yen itself has been very strong, and I think it's going to break out as we end up with greater crises in Japan, which is the source of so much of this exotic monetary policy. Whenever the Fed
a 112 level come into your work at all in U.S. dollar yen, Peter? 110.05 right now, so another couple.
Is a key number, and I would like to come back to you with I can maybe send you a few charts of the dollar yen cycles. I didn't prepare them. They're really interesting, and we are going to have very severe consequences when the next set of cycles break out, which is right here on the dollar, and the yen is a similar situation. What's so great about these charts is they're energy charts. They're about the passage of time and the transmission of energy. And so that's why I like looking at things this way, because...
And this is your stuff, proprietary stuff. Did you borrow anything on time from Gann, or it's all your creativity that came up with this?
There's a lot of influences that go into this stuff. And
nothing new under the sun.
Traders was a good influence from elders. So, and there's other people too, very talented, who've influenced me in thinking about this stuff. But I've come up with, taking things in pretty different directions personally. But anyway, the dollar is something I really wanted to just say. We know that something's going to be wrong if you see the dollar's over 97.03. And I believe that's going to happen. And I think if the yen is very strong at the same time, then you have to be prepared that we're going to have a banking crisis. And you're going to have some sort of huge crisis. I don't know what it's going to be, where it's going to be, but I'd have to believe that it's going to be Europe and China. And to that end, this is a chart of, you've probably seen this, and I think a lot of the popularity of this chart actually has been because we've been posting it a lot, which is the
what year is this fractal yellow line taken from?
Well, I'm going to recalculate this. Okay, this is the Baltic Dry Index. Shifted 25 days, 25 trading bars in advance in the future. So it's a very interesting fractal, because as globalism has been under more of a threat, this fractal has been incredible at calling bottoms and calling turns. So if you look at it here, it's saying, okay, we're going to go through some sort of a pullback, and we do. And then if you look right here, you can see that it says we're going to bounce. We bounce, and then we pull back again. So these are in advance. So it's basically saying, okay, look for a little low here, look for a little high into around about here, and then look for continued pullback. And then we get this huge trade push, and it nails the high into January, into the end of January. And this is in advance. This is where the Baltic Dry Index peaked. And basically, we had the same situation happening at the end of the year this year. And now we have a period which should have had seasonally strong behavior from the Baltic Dry Index, which was very weak. And when you get a weak fourth quarter in the Baltic Dry Index, you should get a strong first quarter. But what we've had is an exceptionally weak first quarter in addition to a weak fourth quarter. So this to me is extremely troubling, and we can zoom in and take a look at how well this has worked. So the dark line here is the non-shifted Baltic Dry Index, and this is the shifted Baltic Dry Index. And basically, plus or minus a day or two, has pretty much called the lows and highs in the market. So here we are right now. So I would say that what it looks like to me is that from a global trade perspective, we're looking at some very serious problems. And from an economic perspective, we're looking at very serious problems. And so I'm expecting that regardless of this intervention that has happened, which has really been verbal more than anything else.
Except China did do some infusions.
Yeah, China has done their infusions, but the majority of what has happened has been verbal, and China's intervention has been very ineffective. So even though they tried like hell, their intervention has been ineffective. Now, a lot of people are used to the bull market. They're used to the idea.
Buy every dip. Or as they say, BTFP.
Bad news is good news. Good news is good news, etc.
Yeah. Right.
But the difference between markets under liquidity stress and the markets that are not under liquidity stress. So I call that a bear market is a liquidity stressed market for me. I don't really consider a bear market 20% down. I consider a bear market is a market where you are liquidity constrained. And when you have a situation where we have liquidity constraints for available funds for the equity markets, and the central banks are not creating new liquidity. So we are not seeing China created some liquidity, but they're not creating globally enough liquidity to have sustainable
I get it.
In risk.
And the Fed, Peter, even though they've paused on rates, they are still draining reserves every month on their balance sheet, right? And jawboning, but they're still tightening.
Yeah. And so I want to actually talk about that a little bit more, because I think it's so important, especially to the currency markets, which I'm very big into dollar, but I'm not really running around trading all the currency pairs. But I believe that what happens when you get into a liquidity constrained environment is the psychology of people changes, where they trade based on hope. And then when reality is delivered and hope is no longer there, they realize that the hope was great and the reality was not nearly what the hope said it would be. So I believe that if Trump was to get a Chinese deal, it would not turn into something positive for the stock market.
Okay. And might be an event to sell into.
Yes.
Okay. You want a Pinkertism on hope, Peter? Hope is here's a Pinkertism on hope.
Yeah.
Hope is the oxygen in our life and the carbon monoxide in our trading.
Exactly. And that's what, what I believe the central banks and officials tried to do was to create hope, and the idea that the markets could return to the previous style of trade. And we've had this humongous rally, both based on verbal intervention, probably some banking intervention, and a tremendous amount of hope. I think that we're going to unwind this probably exceptionally fast. I think people who are bullish probably will not get the chance to unwind in the way that they would like. And
from these levels, Peter, from these levels, or is there some fumes left in the gas tank of hope before?
Lit on hope. So my view of it is that there's not much. The valuations in the market are hysterically high right now. So it's much, much worse than it was last year. Earnings are down significantly. And here we are with prices, that were intolerable for people, not long ago in October and November. November and December. And earnings are continuing to come down. Liquidity is continuing to contract. So that's why I think this Baltic Dry Index is important. And I want to go to another chart that I posted yesterday. Basically, where we are, this is not the same chart, but it's similar. I maintain a chart of, come on, stupid thing, of,
we see it.
I know I'm trying to move this damn thing and it won't move. Oh. I maintain a chart of the volatility indexes. Let me just see if I can zoom in and get this to move, because I don't know why this is doing this. There. Let's see, where is this bottom? Okay, so the reason that I drew these two boxes was for you guys. I wanted you to see just how this is aggregate volatility. This is all the volatility that there is that I can track reasonably. There's other volatility that I could actually add to this. The problem is I don't have enough of a history on it. It's like you have like 2 or 3 years of some of the instruments and it's not worth it. This is enough. So, but the point is that this is the amount of volatility that was triggered into the lows of 2000 and 2009. And here is the volatility that was triggered in total at the bottom of the February lows.
Right.
Now, what you can see here is that we moved almost twice the amount of price of the February lows.
And vol underperformed on that.
The total
trip,
volatility.
right?
Yeah, and so what does that say to you? To me, as a trader, it tells me that the market was not emotional. They weren't really that scared of it. People sold volatility. Now, whether that was central banks and Powell.
That's what I was going to think, that, it's easier to manipulate the VIX instruments than it is the overall market. What do you think?
I think it is, but it's changing. And I'm not sure if the Fed is really, they used to have an almost $3 trillion short vol book. I'm not sure if they're expanding that again. Powell was in charge of that, and he was supposed to unwind it, and I believe they, for the most part, did. And that was part of why we had this vol implosion over here, the vol explosion. The other problem with this is that we have more and more funds. I think it's easy to credit the central banks for manipulating vol, but it's very important to understand that a lot of the vol manipulations are coming from strategies which are aiming to do volatility targeting or volatility control. And so what they do is they look at if the volatility is rising in the volatility products, they look to lessen their long exposure in S&Ps, either the SPY or the futures. If volatility is declining, they look to increase their exposure, and this is an algorithm. So there's a relationship between the two. And so it's a self-iterating fractal. The more people reduce their vol, the more vol is reduced, the more they buy the S&Ps. The more they buy the S&Ps, the more the vol is reduced. And on the way down, it's also the same. Now, I think that we haven't blown out the volatility, the short vol people, and these strategies are beyond ludicrous. They're stupid, they're risky. They're used by insurance firms who actually want to pretend that this is a safe strategy. And what it really, to me, is just another tail that wags the dog. So we have ultimately, I think, a situation in which vol is going to basically get blown sky high and I think break out over this trend line and probably way exceed the 2009 lows. Now, in that end, I wanted to talk about my work is pointing to an initial target on this next move down around 2050 and an ideal target of a support zone around 1820 to 1850. So this move is very likely to be much bigger on the downside than people are thinking. Now, I don't know what kind of bounce we're going to get at 2050, and I don't. Maybe I'm wrong, and maybe they can come out and try to save everything, but I don't think so. I think that in this chart, I'm showing the reasons why I don't think that's going to happen. Why I don't think they can save the market, because we were too complacent as a whole. And I was posting this live also that at the lows, these were not final lows. I covered my shorts into the 2400s area, 2470s, and upper, basically in the upper 2400s is where I was closing my shorts, and the remainder of them I closed, I think, in the middle, and just sat it out until 2340, and then was more or less biased long after that stabilized there, and then also when we retested the lows at 2440. Now, my expectation was that we would come back up to 2630.
Okay, that's a point. Great segue. So a lot of people started selling this bounce at 2600, 2650, 2690, right here at 61.8. Do you think the rally sellers have been exhausted yet, and now they're tired of trying it, and that could also open the window that we've had massive short covering during this advance, and now we're getting close to where the bears are scratching their heads and saying, yeah, you know what, I'm tired of shorting this market. It's like
I actually 100% believe that's the case. Okay. I believe that what's happened is that from what I was seeing, nobody really wanted to hear at 2,500 about going along, and that the market was going to go up 100 to 130 points. I got a lot of flack for that. And now it's funny because people only notice that I started to get short a little bit earlier than what I had targeted for the market, because that's what I usually do. So I thought we would get to 2616, 2630, and I started getting short in the upper 2500s just to get the toe in the water. And I've maintained a short exposure since then, and have raised my average short price to the 2650s, and trade it around also. And I do something that I would recommend other people do, which is I take long trades when I'm short that are basically designed to offset my short position, and I don't do it in a speculative way. I do it in a risk offset way. So, for example, let's say that I had 500 ES contracts short, I might trade 50 lots long. And so then I'll throw, 5 or 10 shots at being long, and I will be consistently limiting my risk and reducing my margin exposure as well. Because if I'm 50 contracts, if I buy 50 contracts of ES,
Mm-hmm.
I'm short 500. I now I'm
short 450. Yeah.
And,
yeah, it's like a hedge. It's like a little bit of a hedging thing, and you see a rally coming, so you hold a core position and trade around it.
Exactly.
On both sides.
The thing is, this is where time is such an important element in trading. I have a swing position which might end up getting, like last year in 2017, I got 3 trades that were around about 300 points or greater in my trading, which is a very unusual thing to do. I have not done that before in 1 year. So that's, and basically what happens is that you hold those trades, and I'm thinking that we're going to get more than 300 points down now, or 400. We're probably going to get 600 or more. And so during that time, I might be holding this trade for another month and a half. But during that time, I get to maybe potentially do 30 or 40 or 50 or 60 long trades. And that is using time to your advantage. Instead of just sitting there in a position exposed, you can do other things that are specifically mentally liberating and also offsetting, the use and allocation of risk in one direction with a very objective way of reducing that risk and using time to your advantage, where you can take multiple stabs at stuff. And I use a tool set called Tick Tools, which I have shared for the time being publicly on the internet, so that people can hopefully do the same thing to a degree. Let me see if I can. Let's see here.
And
so
also, Peter, after that, for people that are hearing us live and watch the video later, the best way for people to follow you and get in touch with you.
Okay, well, on the website, on the Twitter, it's MCM_CT.
Right.
Which is the easiest way to find me.
Okay.
And for right now at zoom.us, I have a free share, kind of like what you guys are doing, but no talking. It's just showing Tick Tools live signals. And basically, I'm going to try to see if I can get it here. So all you do is you go join a meeting. So you click on join a meeting.
Mm-hmm.
And it should ask. There it is. And the meeting number stays the same every day. It's 533. I don't know why this is so slow. 533-3355. And then you just join, and you can see the charts in real time. And what Tick Tools does allows me to, I can actually show you a rough chart of it here, where we are. Come on. I think that webinar, so come on. I can't.
Make that
Maybe
mouse
it's because
run.
of my.
Make that mouse run faster around the wheel that's powering.
Yeah,
your,
I know this is my laptop,
today.
so I don't know what's going on with it. But
I use one too.
The Tick Tools is an amazing tool set at analyzing the real-time emotions that are going on in the marketplace. I fixed it.
Okay.
And basically, here finally it moved. Okay, so. Let's see if I can. Something's going on with my machine. I can't show you my charts. All
right, but that's fine.
But
at least people know.
Nonetheless, a really interesting chart, by the way. This is vol adjusted for flow, and take a look at what it's suggesting vol should be. So the VIX index should be about 34 right now, according to. which is an interesting subject. And let's see, there's one other. Here's another chart, and I want to show you guys this because now I see what's happening. Okay, we had the market open, and I have tons of data that reloads, and so it's reloading and recalculating, and that's the problem.
Okay.
But basically, there's a bunch of participation indexes which I have, and they have all been extremely moderate on this rally. So where I see a lot of people on the internet talking about advanced decline line is very strong. It's here. It's fine. Where I see a lot of people talking about advanced decline line is very strong. Come on. It's this machine is recalculating a ton of stuff right now, and that's the problem. So I didn't expect that. But what's really happening is that advanced decline is not a good measure for the market anymore. Advanced decline is a corrupt measurement of the breadth of the market. And the reason it's a corrupt measurement is because we now have more ETFs in the US markets than we do stocks, or at least equal. And ETFs are considered a part of advanced decline. So you basically have a situation where ETFs are constantly affecting flows, and then you have a situation in which the number of stocks is continually declining. So the number of stocks that we are trading, or that you see that are trading live, are down by, I think, about 70%, 68% or something like that from 2000. So the universe of stocks to trade are down incredibly.
Yeah.
And each time you reduce the stock, you now have less places for liquidity to go. And so if you're comparing yesterday's advancers to today's advancers, you have less stocks today. So that's going to make your comparisons always look more positive. And the same thing is going on because we have still an episode of buybacks, which is still in progress at a very high level, which continues to.
I wanted to ask you that. Someone I interviewed said that February was a blackout period for buybacks. Is that true?
During earnings, yes.
Okay, so until the earnings season is over, there are no buybacks going on.
Well, they're limited, yeah.
Okay, but not the whole month of February.
No, and so so the point is that let's see if this is still not reloaded. Okay, here we go. This was a chart I wanted to show you, but it's going to take a while to calculate. We just had the unfortunate.
Peter? Yeah. So, but you know what? Don't sell yourself short, because you gave us enough pearls today in 48 minutes to string a necklace.
Well,
so I would I have to thank you. I mean, I never followed Baltic with the market, and a lot of the things that you said, give me conviction for what I'm planning to do. And really, I thank you so much for coming back. And I wasn't sure, but this was even better than the last one. So appreciate you edifying our community, Peter.
Yeah, well, it's fun to speak to you guys all the time and every time, and I appreciate being invited back.
Okay. Well, let's do it again a few months down the road and see how things are playing out. And I wish you nothing but pips raining down on you while it's raining in the economy, Peter. So, good hunting, and stay in touch with me, my trading warrior brother. Okay.
Okay. Yeah, you too.
All right, everyone, that's Peter Campbell. You can follow him on Twitter at MCM_CT and go to his website. And this guy is a very creative, deep thinker, musician turned analyst trader, and should be part of your intelligence gathering, in my extremely accurate and humble opinion. So that's a wrap. And many people are saying here that they're going to be following you, Peter. Remember, don't just count your pips, count your blessings, and we'll see everyone for Turnaround Tuesday. Adios. Thanks again, Peter.
Okay.
And the video will be produced and out in a couple hours, my friend.
Well, you know what? I actually can show you this index now, if you guys would be interested.
All right, go ahead. I won't end it. Go ahead.
So let me just, this will take 2 seconds to recalculate now.
All right.
There. Okay. So basically, here we have, this is something that I do that not a lot of people do. I actually calculate what volatility indexes should be. That's this red line. And this blue line here is realized vol. So the volatility indexes are still trading at a significant discount to realized volatility, which means that we should be expecting some sort of a volatility upsurge relatively soon. And then this is the participation index. This is sort of derived from Tick Tools, execution sentiment index, run on multiple different ways. It's very tedious and very time consuming to calculate, which is why you saw my machine basically grind to a halt. What you can see is that ever since we had this end of the year move into 2017 and early 18, we've been getting sold into. So then we have this big move off the low, and one of the reasons I was positive about the initial move into about 2,600 was because we had decent participation. Since then, from here on out, participation has been horrible. So what we're looking at is people selling into these highs. Now, if you use the advanced decline indexes and you use regular tick and stuff like that that people have on, that you can get in, stock charts, for example, it's useful, but it's very important to recognize that the frailty of the markets is one where we have created an echo chamber that is self-reinforcing of positive expectations and positive hope. So one of the ways that happens is when you reduce shares, you reduce issues that are traded, and you make comparisons between history that is not comparable to the future. So if you're doing advanced decline line assessments today and you compare them to last month, you're not comparing the same market. You compare them to 6 months before, you're not comparing the same market. We have more ETFs coming out. We have less stocks to trade. We have smaller floats in each thing. It's very important that people recognize that these things that people think are objective are not objective at all. What they are is an echo chamber. And if you want to know what's happening in the market, this index is telling you that we're not getting participation into each one of these highs, and now on this really big move, we're not getting participation. And we did initially get decent participation into about 2,600. And that's why when that started to sort of lessen, I felt like we had a decent shot at a reversal somewhere in that area. And this behavior from here to there has been rather surprising to me. And I think that it's going to end very much like this. So if you look at the last time that this happened, we had some decent participation, making some highs. And then we had lousy participation into the final highs into September 21st. And then what we ended up getting was a disaster. And,
yeah, I had a guest on who said this: the market's job is to convince us it's something it isn't.
Exactly.
And when you talk about AD, that kind of reminded me of that.
Yeah.
So
this was a very, if I was able to help anybody in taking a skeptical view of what's going on with advanced decline and tick, I like the tick index and I use it, but very rarely, because what I needed to do is I needed to write my own tool set that goes and looks at every trade and then calculates a more meaningful number out of those trades than something that is going to be filtered through this echo chamber. And that's what these tools are about. And that's what gives me this ability to say, okay, well, what's happening in the market? And I can tell you it's being sold. So, not a lot of people can do that.
That's why I had you back, bro. So you just added conviction to, there's this thing called a February break. I'm expecting a lot of markets had banner Januaries. I'm expecting the air to come out of the balloon in February, and most markets that had very good Januaries. So
I think you're right on the money there.
All right. So happy Valentine's Day.
Thank you.
All right, buddy.
Thank you for inviting me back. It's always great to speak to you, and I appreciate everybody being a little patient with my machine basically grinding to a halt when the market opened.
You know what? Every minute was worth it. Thanks again, Peter. Good hunting, and keep in touch, please. And good luck on this call.
Okay. Bye-bye.
All right, everyone. That's Peter Campbell, and everyone knows where they could follow him, and I recommend you do so. So with that being said, have a great afternoon, great evening. See everyone for Turnaround Tuesday. Thank you, Martin. So Peter, another great interview, Martin Cinder said. So thanks again, everyone. Enjoy your day. Don't just count your pips, count your blessings, and we'll all see you here tomorrow morning. Adios.
Okay.